Some people think that investing is risky, but as long as you invest for the long term and build a diversified portfolio which contains the biggest and best companies in the world, then the downside is limited, but the upside potential is huge.
Regular watchers of this channel will know that we build the core of our investment portfolio using ETFs and supplement them with other investments that we think will give our returns a powerful boost. One way we do this is with specially selected stocks that we think will continue to dominate their space for decades to come. We feel every investor needs to hold a significant position in these two stocks in their portfolio.
In this video, we're going to be looking at 2 essential stocks that we think every investor should own and why. Let's check it out. Welcome to Unshackled.com, the investment and finance channel and website that sets you and your finances free.
That was Andy and I'm Ben, and if you like what we say, hit the like button and click subscribe.
We want to give a special shout out to Stake, who are sponsoring this video. You can buy both of these stocks on the Stake app, which specialises in US shares.
It has over 3,700 US stocks and ETFs available, including all the US stock market giants. What's more, Stake offers unlimited commission-free fractional trading with trades executed in real time, and it is of course FCA regulated and a straightforward, no-nonsense pricing.
And for a limited time, Stake are giving away a free US stock worth up to $100 when you sign up via our link. We'll put the link to the offer page in the description below, so be sure to check that out. Now let's get into the video. Number 1, Microsoft. Microsoft is in a constant battle with Apple to be the biggest company in the world. One minute Apple is king, next minute Microsoft rules the roost. It's an absolute colossus with a market capitalisation of around $1.5 trillion. The rounding that we're applying to this number is worth more than most individual companies in the entire world. It's insane and just goes to show just how ginormous this company is.
To put that into perspective, the FTSE 100, which is the index of the UK's largest 100 companies, has a total market cap of around £1.8 trillion or $2.2 trillion. Microsoft, just one company, is not too far off from being worth more than all of the UK's top 100 companies combined.
For a long time, Microsoft was the forgotten giant which had lost its way, but in recent years, the sleeping giant has awoken. As this chart shows, there was a massive surge during the dot-com boom, but it was pretty much static for the next 15 years. Since then, Microsoft had really perfected its business proposition, and the market has been impressed with what it's seen, as have we.
Fundamentals. The share price at time of filming is around $214, which puts it on a price-earnings ratio of 37.5. This is potentially a scary valuation considering the S&P 500 is on a price-earnings ratio of about 22. Which in itself is considered high by many analysts right now. On the other hand, Microsoft is a tech giant, and the technology sector is notorious for having sky-high price-earnings ratios of 60+, which could indicate that Microsoft is still a steal.
As investors for cash flow, we love dividend-paying stocks, and Microsoft has an awesome track record. Of course, when the share price increases so rapidly, the yield will naturally come down. But yield isn't the only thing that we look for when picking income stocks. The dividend yield is now only about 1%, but this is on the low end due to incredible share price appreciation recently. One thing we look for when stock picking is a consistent and reliable dividend which grows at a sustainable rate over time. What we don't like is dividend cuts. Microsoft is showing all the right signs.
Domination. What we love about Microsoft is its vast product portfolio, and that the majority of its products are not just market leaders, but also essential products for its customers. Windows is the overwhelmingly dominant operating system for the PC market, and its productivity apps such as Word and Excel are absolutely vital for businesses. So much so that they are the industry standard, and it is practically impossible to now use an alternative.
Over a decade ago, I used to work for IBM, who had their own office software called IBM Lotus Smart Suite that they tried to sell to their customers. The hypocrisy was that internally, IBM used Microsoft Office because it was the superior product. Lotus has since been discontinued, but if an office software developer such as IBM cannot escape the Microsoft ecosystem, what chance does any other business?
Incredibly, Microsoft's pricing is extremely cheap. A business can get all of this for less than £10 a month, whereas other software giants that dominate their space, such as Adobe, charge about £60 per month. There is plenty of room to raise prices without much risk of losing customers, and that's a great position to be in.
Microsoft Azure is already the world's second biggest cloud analytics and applications platform, behind only Amazon's AWS. This is a real growth area for Microsoft, with experts believing cloud computing has decades of growth ahead. which is incredible considering Azure already made $26.1 billion of revenue last year.
Scale and passivity. Our regular viewers will know that we love scalability and passivity more than anything else. We look for the most efficient way of maximizing income for the least amount of effort, and this is also exactly what we look for in a business. Microsoft ticks all these boxes.
They have tremendous scale. This is because they create software packages that can be sold to more and more customers without many additional costs. They have been able to capitalise on this by selling to every country in the world.
The passivity comes as they have moved to a subscription service whereby their customers are continually paying to use their products and services. From office productivity apps to saving your files and photos in the cloud using OneDrive to monthly subscriptions on Xbox Live Gold, they have a constant flow of money pouring in that shows no sign of stopping.
Number 2, Amazon. Amazon is a behemoth with a market cap of $1.4 trillion. For years, most people would have considered Amazon to be an online bookstore and eventually an online store that sells everything. But this is seriously understating the activities of this supergiant and the direction that it is headed in.
Amazon isn't just a retail company. Amazon is a tech company that is present in every facet of life. From obvious services such as retail and delivery, to consumer electronics, logistics, digital content such as the downstream delivery of music, books and video, content creation via Amazon Studios, cloud computing, drone technology, groceries and many more.
There seems to be no end to what Amazon will do, and all businesses ought to be terrified of Amazon entering their space. Amazon have completely upended the book industry to the point where most people wouldn't even know where else to go to buy a book. Can you name a single other store that sells audiobooks?
Amazon's share price is a whopping $3,182. And although this price chart seems to show no growth until recently, that isn't the full story. The chart scale lessens the impact of its growth over time. In June 2006, it was around $35, and by September 2011, it was $223, which was over 500% growth in just 5 years. That incredible growth rate has continued to this day. Can it continue further?
A lot of investors won't even be able to afford one Amazon share at over $3,000 per share, but thankfully some investment platforms, such as our video sponsor Stake, offer fractional investing which break down these barriers.
Fundamentals. Our biggest concern with Amazon is its price-earnings ratio, which without context could be considered to be absolutely crazy. It comes in at an eye-watering 147, which normally we wouldn't go anywhere near. However, we think that Amazon may be the exception that breaks the rule due to its rapid growth and track record for game-changing innovations. The company's net income more than tripled year over year in 2018, rising from $3 billion in 2017 to $10.1 billion in 2018. It was then able to continue to grow to $11.6 billion in 2019.
Amazon is in its world domination stage of its life cycle and so doesn't pay any dividends. As cash flow investors, this is often a deal breaker, but it would be wrong for Amazon to pay out cash right now when it has demonstrated the incredible returns it can generate when it reinvests that free cash back into the business. It has proved that it can invest our cash much better than we can ourselves.
Locations. Surprisingly, Amazon doesn't have online stores in that many countries. We actually have no idea where other countries shop without a local Amazon site. It seems inconceivable to think that Australia only got an Amazon site in 2017. When in the UK, Amazon dominates 30% of the e-commerce market, while in the US it is 49%.
Countries without their own dedicated store can of course use other Amazon sites, but this is clearly not going to give it the same dominance of market share. It's clear that Amazon has an absolute ton of growth potential in the future by entering new geographies.
Relentless innovation. You have to be impressed with the relentless innovation that comes from Amazon. The speed is devastating. Areas such as parcel delivery have been immeasurably enhanced by Amazon. No longer do we have to suffer waiting days for an item to arrive. In some cases, we can now get it in hours.
They have also installed delivery lockers the length and breadth of the country in places like train stations and shops. No matter how small and unimportant these innovations might seem, what they are achieving is customer stickiness. They are locking their customers into the Amazon ecosystem. People won't even bother to shop elsewhere because of the hassle.
Essential business. During the lockdown of 2020, the country was saved from coming to an absolute grinding halt, largely in part to Amazon deliveries. A national lockdown simply would not have been possible just a few years ago. Amazon was classified as an essential business, which allowed us all to buy pretty much anything we wanted despite being housebound. That just goes to show how vital this company is to our lives.
Race to dominate the home. Google control online search, but Amazon is winning the race to control the home with their smart speakers. We won't say the A word. From turning on lights to playing music, to starting robo-vacuums and answering questions. Home assistants are the next great frontier, and Amazon have a clear advantage here as they can seamlessly bring many of their service offerings together.
Amazon Echo devices have a market share of 70% in the US. Market share is crucial in these key battlegrounds, because it's often third-party developers who ultimately create monopolies on behalf of the tech giants. For smart speakers, it will be a race towards which speaker can provide the most functionality.
To explain this better, consider mobile phone app stores. Third-party applications have given Google and Apple app stores monopolies. No other mobile operating system software will be born because it won't have an adequate app store. It's a vicious cycle. Amazon has that dominance in the smart speaker race.
Question of the day: what other stocks would you consider to be essential holdings? Let us know in the comments below.
Thanks for watching. On this channel we talk a lot about personal finance, investing and all things money. If you want to see more great content, please click the subscribe button below.
This is MoneyUnshackled.com. See you next time.